Now, if we have to move ahead in this particular aspect, and then we let us see what we saw was basically we said that return goods to engineer, that is we looked at the 16th transaction was out there. Then the 17th and 18th transaction, if you look at, it is relatively easier, simple. If you look at the 17th transaction, it just says cash purchases to the extent of rupees 200. It does not even tell you from whom you have bought in the process. It does not even tell you from whom, because moment there is a cash purchase, that is what is happening. One asset coming in, another asset going out. What is the asset that is coming in? Goods is coming in. Goods is basically coming in, that is basically debted, debtors out there, that will be debited, that will be debited to the extent of $200, and debit what comes in, credit what goes out. What is going out? Basically cash is going out in the process. So, cash I credit to the extent of 200. Now, normally in accounting what we say is, we will say typically an accounting book will look like this. There will be multiple columns. On top of this column they will write debit, they will on top of this column they will normally write what is called as credit out here. They will basically, if I have to typically say that how accounting as statements of record, they will say this is credit side of the whole thing, this is debit of the whole thing, and that is how basically it will be recorded out there. I am not being a very typical accountant in that sense. So, I am just broadly telling you or helping you understand the basic philosophy behind this entire thing. Next, it says that cash sales to the extent of 375. Moment it says cash sales, please note there is something happening. What is happening? There is a cash that is basically coming into the business out there, cash account debited. What is the amount? $375 is the amount out there, that is basically coming into your business. Now, what is happening? The other asset that is also getting affected is basically what is called as your goods are going out, and that is also that is debit what comes in, credit what goes out. That is what is coming, cash has come in, you are debited. What is going out, that is sales is going out, that is goods are going out, you have basically credited that part of it. So, that is what basically we have done in this particular case. Moving further, it says that if I look at the 19th transaction, it says that withdrew from bank for office use rupees 1000. Withdrew from bank for office use rupees 1000. Now, what is happening? There is an asset, one asset is reducing, another asset is increasing. What is the asset that is increasing? Cash is an asset that is increasing, that is what does it say? Debit what comes in, what is coming in? Cash is coming in, cash account is debited, how much? To the extent of 1000. Now, what do we say? Credit what goes out, credit debit what comes in, credit what goes out. Basically what is going out in the process? Bank account is what is called as, in the debit what comes in, credit what goes out. Out here what is going out? Money is going out of the bank in the process, and then what is the extent to which it is 1000. Both are what is called as assets out there. So, they both come under what is called as the real account principle, and in real account principle debit what comes in, credit what goes out. That is what is coming in, cash is coming in, bank account is basically going out, and since money is reducing to that extent in the process out there. Next, I read the next transaction. It says provided loan to Amarnath rupees 200. Provided loan, that is you have given a loan to Amarnath. Now, what is happening? When you give a loan, there is something, what happens? There is cash going out, there is an asset that is going out. What is the asset that is going out? Cash is going out. So, what happens? Cash account is debited, sorry, cash account is credited to the extent of about 200. Please follow the columns to debit column. What do you call it as? You can say there are two columns out there, debit, and there is another column out there, credit out there. We say CR and then we say DR in the process. Now, you are given, that is there is cash that is gone out. So, you have credited cash, perfectly all right. Now, what happens? Amarnath loan account, what is loan? When you are given a loan, when you given a loan, it is an asset, somebody can say, because it will appear as a loan given in the asset side of the balance sheet, perfectly all right. But who is receiving that? Debit the receiver, credit the giver out there. Who is receiving that loan? Amarnath is receiving the loan. It says Amarnath's loan account debited rupees 200 in the process. So, what is happening? There is a loan that is given to Amarnath in the process, Amarnath loan account, loan that is given to Amarnath in the process. So, that is what basically you will actually see this. We have another 7 more transactions or 8 more transactions, that is goes through these transactions, and then let us, after that we will take a break out there. Then it says that bought goods from Savdeja, bought goods from Savdeja rupees 300. Again, in this particular case, there is nothing, there is no, what do you call it, as cash involved, because it says bought goods from a person, that is unless until, as I said earlier, unless until otherwise specified, unless until otherwise specified as cash, all transactions are taken as credit out there. In this particular case, it says that bought goods from Savadega out there, it is rupees 300. So, when you buy goods, what is happening? Purchases. Why purchases? Because goods are coming in. Debit what comes in, how much? 300. Credit what goes out. What is going out there? Is there nothing going out, that is bought. Only thing is, who is giving you this credit purchase? Who is giving you this credit on the purchase? Debit what comes, that is debit the receiver, credit the giver. Who is giving you this credit? That is basically your creditor out there. Sorry, I am sorry, your you got to pay, sorry, your creditor out there, and that person who is giving you that credit is Savdega. Savdega is giving that credit to you. Debit the receiver, credit the giver. In this particular case, who is the giver? Savdega is the giver, and I am credited his account to the extent of about $300 out there. With you on this? If I move ahead further, sold goods to Thankat for cash rupees 400. I have taken only purchase and sales, because you need to know the effect of what happens when an asset goes out, when an asset comes in. Please keep visualizing how what happens in your balance sheet when the asset goes out and the asset comes in. In this transaction, if I look at the previous transaction, what we said, purchase of goods and credit to Savdega. What happens when the purchase of good happen? The asset increases. That is, on the asset side, there is a purchase that has happened and the asset increases. What happens on the liability side? On the liability side, this creditors goes and sit there to the extent of say 300, and your liabilities also increases. So, what happens to your balance sheet? Your balance sheet basically balances in the particular case. Now, are you able to visualize this whole thing? So, if you are able to visualize, go back to your first class and then see what we did, and then first week classes are there, and then see what we did, and then basically you will be able to visualize this process out there. That is, your asset increases, your liability also increases, your balance sheet basically balances in this particular case out there as we go along. If I move to the next one, sold goods to Thankat for cash. When I say sold goods to Thankat for cash, then what happens? Thankat for me, for as far as an accountant is concerned, Thankat is immaterial for me. Why Thankat is immaterial for me? Because the goods are sold for cash. Once the goods are sold for cash out there, then the money has come in, and then that is sufficient for me. So, what happens? There is what is happening in this particular transaction when I sold goods for cash. Cash is basically coming into my business. Debit what comes in, and then how much of cash is coming in? Cash is coming in to the extent of about $400. Now, it is coming in, and because of what? Is somebody giving? Yes, somebody is giving, but basically what is happening? Debit what comes in, credit what goes out. What is going out? There is goods which is going out, that is basically we call it as sales, or what you call it as goods, which is basically going out there to the extent of another $400 out there. Goods which is going out to the, because I am not bothered who has given this basic what do you call it as this particular aspect to me. So, that is what basically happens in this particular case. Move on next. In this particular case, if I have to move on, paid for office rent rupees 150. Imagine you are paid, you are given it in the form of a check, you are not even given in the form of a cash out there, you are given in the form of a check out there. Imagine you are given in the form of a check out there, you are not even given in the form of a cash. When you are paid office rent, what is office rent? Office rent is basically an expenditure, expenses. When you pay, when it is an expenses, what is it? debit all expenses and losses, credit all incomes and gains. That is what we basically say. Debit all expenses and losses, credit all incomes and gains is what we normally say. So, when we debit all incomes and expenditure, debit all expenses and losses, what happens? This office rent is what is, it is an expenditure, though I debit this expenditure to the extent of 150. What is the other side of the transaction? The other side of the transaction is basically there is something that is going out. What is going out is basically bank account is going out, debit what comes in, credit what goes out. What is going out? Bank account is going out to the extent of about 150 in the process out there. So, again I repeat in this transaction. If I relook in this transaction, relook at this transaction, what happens? Office rent as such is an expenditure. It comes under the principle of nominal account. Go back and check. It comes under the principle of nominal account out here. Nominal account, what do we say? We say that, what do you call it as in the nominal account principle? We say, we basically say that debit all expenditure and losses, credit all incomes and gains. So, what have we done? This is an expenditure, office rent is an expenditure which I have basically debited out there. That is what I have basically done. Office rent is basically an expenditure which I have debited to the extent of 150. That is what you see. Now, what is happening to the other side of the transaction? That is, there is a cash that is going out. What is cash? Cash is nothing but an asset for me. An asset is basically going out of my business out there. So, I have credited asset out there to the extent of $150 out there. That is what basically it is. Now, next transaction if I have to look at, it says paid office salaries rupees 250. Similar to this. Similar to this. What is similar? Office salary. Salary is what? Is it an expenditure, income, loss, gain, asset, liability, individual, entity, etc.? It is basically, what is it? It is nothing but an expenditure. Moment you have an expenditure, what happens? Debit all expenses and losses, credit all incomes and gains. When I say debit all income, expenditure and losses, I will debit this expenditure and I will basically say salaries debited to the extent of how much? If I have to debit, I debit about 250. What is happening? There could be cash that is going out or the bank account that is going out in the process. I will say to bank account, that is basically why, because money is going out of the bank out there, that is $250 in the process. That is what I basically recorded out here. That is, bank money, cash that is going out is an asset, debit what comes in, credit what goes out. What is going out I have recorded. Salary is an expenditure, debit all expenses and losses, credit all income and gain. What have I done? Salaries is an expenditure that I have debited $250 out there. That is all. Visualize this, how this will affect the transaction in the balance sheet. Bank account, it has gone down. So, what happens? Your asset balance, whatever it is, comes down by $250. Accepted. Salaries is an expenditure, it will not appear in the balance sheet. Where it will appear? It will appear in the P&L account. Yes. Moment it will appear in the P&L account as an expenditure, what happens? Your profit comes down to the extent of 250 rupees. So, what happens? That profit is getting added to your capital on the liabilities plus capital side of your balance sheet. When it is getting added to the liabilities plus capital on the liability side of the liabilities plus capital out there, what is that happening? Because you are writing this as an expenditure, the profit is getting added by about rupees 250 less out there. Then what happens to your balance sheet? Your balance sheet is automatically balancing. Imagine there is no other transaction, this is the only transaction that has happened in the company for a time being, for hypothetically imagine. Then what happens? My P&L account will look like this. Salary is 250. So, no income, income is null. So, finally, you will say record loss of $250 negative. Now, what happens in the balance sheet? Whatever is my asset out there, that is my bank account, my bank account has gone down by $250. Now, what is happening? This loss is also coming in here as $250 out there. Then what happens? Your basically balance sheet will get taken care of and get balanced in the process out there. Move on to the next transaction out here. Paid for general expenditure rupees 25. Moment it says expenditure, debit all expenses and losses. It says moment it says expenditure itself, I will basically debit all expenditure and losses 25, and then what is happening, since it is a small amount, I will write as cash account is 25 out there. What is happening? When you pay for general expenditure, there is something happening, that is cash is getting out of your company. When cash is getting out of your company, then debit what comes in, credit what goes out. What is going out? Cash is going out. I have credited cash in the process. Move on further. Any questions at this stage? Pratik? Nothing? Let us go on. It says that last 3 transactions I have purchased goods from Abidali. I am sorry, I need to wear my specs out there. Purchased goods from Abidali rupees 100. Again it says name of an individual. It does not say cash. When you say purchases, what is happening? Goods coming in, debit what comes in, purchases, that is basically goods are coming in, and then debit what comes in, what is coming in to the extent of about $100. Is any other asset going out? That is there a cash that is going out? No, there is no cash that is going out. What is happening? Debit the receiver, credit the giver. Who is giving you this credit? Abid Ali is giving you this credit. That is basically there is a creditor, and then the name is Abid Ali, who is giving you this credit to the extent of how much? To the extent of about $100. Debit the receiver, credit the giver. Normally, if you look at typical accountants, after early journal entry, they will write something called as a narration. Why is the journal entry? They will say, you will write being bought goods from Abid Ali on credit. After every transaction, they will write what is called as this narration. That is normally the practice out there. The narration is a practice which they will write every transaction, because just by looking at what account is debited and what account is credited, I will have no idea about what is this particular transaction. There is no way that I will be able to make out from what is debited and what is credited as to what is this transaction. So, every transaction will normally carry what is called as a narration out there. Typically, if I have to look at, there will a journal will always have what is called as a date column, then it has what is called as a particulars, then it will have what is called as a ledger folio number, that is to which ledger it is being posted, what is the number, then it will have what is called as a debit column, then it will have what is called as a credit column. That is how basically it will operate out here. This is how typically journals will basically look at. We are not being typical accountants. The idea of this entire class is basically for you to help you understand for you to basically help you understand what is going on behind what is called as a P&L and a balance sheet. You see a P&L and a balance sheet out there, how does it get prepared, what goes on, that is the purpose. So, that is where I have not gone in very specifically very detailed in that sense, but I have just what you call it as kept it, but this is the normal structure of a ledger account out there. Now, it says withdrew from bank for personal use rupees 500. When it says withdrew from bank for personal use rupees 500, please understand, when you withdraw money, is it withdrawing money, is there money getting out of the bank, is there money getting out there of the bank? Yes, money is getting out of the bank. When money is getting out of the bank, what happens? Basically bank account is credited to the extent of how much? To the extent of about 500, normally you will say to bank. Why is it being credited? Because withdrawing money. Who is withdrawing? Are you withdrawing for office? If you are withdrawing for office, then it will be cash. Office, that is the office is getting the cash, that is money coming into the office, cash. Now, what is happening? Here the partner is taking the money and getting out of the business. The partner is taking money and getting out of the business. That is what is he doing? He is basically drawing money, drawings of what is called as the Nut Kearney in this particular case. In this case, Nut Kearney's account debited rupees 500 in this particular case out there. There is what is called as drawings. Please understand what we have done. We have looked at the balance. Go back to the balance sheet what we did. We say when the partner withdraws capital, withdraws money from the business, what happens is capital reduces out there. In this particular case, you see this. Your bank balance comes down by 500, partner's capital on the other side also comes down by 500. Your balance sheet will basically balance out there, take care of it in the process. That is what basically happens in this particular transaction. Now, I look at the last transaction out there, bought stationery for cash rupees 500 out there. What is happening? Cash is basically going out of the business out there. So, debit what comes in, credit what goes out. What is going out? Cash is going out. I have credited cash. What is coming in? Basically, it is consumables or stationery which you own, that is stationery or consumables is coming in. I will write consumables debited because you own the consumables, and that is what we did. In the sense, consumables debited $25, and then there is a cash that is going out, that is what we call it as typically $25 out there. That is what we did. Now, we will take all this. I will have what you call it as a Excel. In an Excel, I have sort of written all these transactions, because this is, as we teach, we write out here. We also will give and share an Excel file which will also be there. You look at the Excel file, most of these transactions are better written, in the sense more legibly written out there. You use this as your ready reckoner out there, and then try and see that. And further, as we go along, we will go to the next stage, that is basically what we call it as the ledger account, and then further after the ledger account we will go into the preparing the balance sheet and the P&L account. Thank you.